My webinar today is presented by Deb Giuliani. Deb has a background in the Big Four locally and overseas, and she's also contributing writer to Taxpayers Australia Inc. and has lectured in tax at Kaplan Business School. Debbie's high level of tax consulting experience and lively personality have combined to ensure that clients receive an informative yet entertaining training session. Delighted to have you on board again. Hi Deb, how are you doing?
I think the most entertaining part about that session is listening to that bio. Michelle, you know I hate that bio. I absolutely hate it.
You've got to give me an updated one then, Deb.
I do. I have to laugh so I don't cry.
Enjoy the session, everyone. Thanks, Deb.
Good morning, everyone. Welcome to your special topic update. Oh, sorry, not special topic update. That's a combination of yesterday and today. Just special topic we're going to be doing today for the month, which, as Michelle kindly said, is the GST implications for importers and exporters. Now, what this paper does, it's broken up into sections, and it firstly looks at the GST implications of importing goods. We're then going to look at exporting goods. We're then going to look at the GST implications of supplying services or intangibles to non-residents, so basically anything that isn't a good. And lastly, we're going to look at the GST implications of acquiring services or intangibles from offshore. So if I use very relaxed language, importing and exporting goods and importing and exporting services or other intangibles. Now, I do have to confess, guys, this paper it's technical. GST is technical. It's just not the most exciting, entertaining paper that you're ever going to be presented. But it's one of those papers where unless you work in this space in relation to GST, in relation to importers and exporters, you're probably not actually going to necessarily remember much of what I tell you today, because it is one of those areas of GST where you sort of need to sit down and work through the provisions and work through the notes. And to be honest, I think this particular session, one of the most valuable things you'll get from it is actually the full paper. Now, you've all been sent the paper. I'm going to quickly flip to it now. I'm not going to go through it, but this is what it looks like. You've been sent a link to it, and it's a very, very, very good paper. It's broken up into those 4 sections, which I talked to you about, and it takes you through systematically the provisions that you need to work through to work out if your importation of goods is subject to GST or whether your export of goods, for example, is GST-free, and similar with services and intangibles. So, to be honest, as I said, I think that the paper is one of the more valuable things you'll actually take from today. This is one of those papers where I always think if we did another session tomorrow afternoon and it was just a series of polls or quick quizzes that went over what we went through today, I think the vast majority of people would get most of it wrong. It's just one of those areas that doesn't sink in and doesn't seem entirely natural to people. I think a lot of people find this part of GST a little bit counterintuitive. But anyway, let's make a start nonetheless. Now, one way that a supply can be subject to GST in Australia is if it is a taxable supply. Now, taxable supply is one of the basic fundamentals of Australian GST. There's only a GST liability if an entity makes a taxable supply. Now, an entity will only make a taxable supply if the entity is registered or required to be registered in Australia for GST. So that will automatically take some non-residents out of the realm of being able to make a taxable supply. So we've got a supplier who's registered or required to be registered. The supply is made in the course or furtherance of an enterprise that the entity carries on. It's made for consideration and, importantly, is connected with the indirect tax zone. So every time you see ITZ, and you'll see it a lot when you start when you do reading in respect of GST and cross-border transactions, you'll read a lot about ITZ. It's the indirect tax zone. It's basically the definition of Australia. When you read the definition of indirect tax zone, it does take you back into the Income Tax Assessment Act and makes a few modifications, but broadly it's the definition of Australia. Funnily enough, it's quite a complicated definition. It includes certain islands and excludes certain islands, and it's this territorial waters but not those territorial waters. It's a bit complicated, but every time you see ITZ, broadly just read Australia. So, for there to be a taxable supply, we've got to have the supply being made by someone who's registered, they're carrying on an enterprise, they're made up for consideration, and there's a connection to Australia. Now, how do we have a connection to Australia for there to be a taxable supply? Well, if it's a supply of goods, if the goods are wholly supplied within Australia, then of course there's a connection to Australia. So you or I walking into Bunnings and buying a lawnmower is a supply of goods wholly within Australia because Bunnings is registered. It's making the supply of the lawnmower to me in the course of their furtherance of their enterprise. I'm paying consideration, and it's connected with the indirect tax zone because the supply of goods is wholly within Australia. So your absolute basics. Now, a supply of goods from Australia will be a taxable supply if the goods are removed from Australia. Now, that might lead some of you to be thinking, well, hang on a minute, I thought exports of goods, where the goods are removed from Australia, were GST free. And they may very well be, but we'll go through that separately. But the reality is that they will be a taxable supply. The export of goods or the supply of goods from Australia will be a taxable supply if it's made by someone registered, unless the criteria for a GST-free export is met. And we'll go through that criteria for the otherwise taxable supply to be treated as GST-free later when we get to the export of goods section. Now, if it's a supply of goods into Australia, and the goods are physically brought into Australia, it will only be a taxable supply and subject to Australian GST if the supplier imports the goods into Australia. Now, whether or not the supplier is the importer or whether the recipient is the importer very much comes down to shipping terms. So you need to understand your free on board versus your delivery duty paid, and you need to understand the shipping terms and have access to the shipping documentation, which will usually set out who's the importer. But unless the offshore party is the importer of the goods into Australia, it will not be a taxable supply. Supplies of real property, where the real property is in Australia, will obviously have a connection to Australia and will therefore potentially be a taxable supply. Keep in mind that anything that's input taxed or GST free is obviously not a taxable supply. And importantly, if it's a supply of anything else, because all these criteria that we've been through so far has been goods and real property. So if the supply is of anything else other than goods or real property, it will have a connection to Australia if the thing is done in Australia. So for example, if it's a service that I'm being provided with, is the service being provided here? Is the supplier making the supply through an enterprise that it carries on in Australia? Enterprise is very similar in concept to a permanent establishment for income tax purposes. So does the supply have a presence here in Australia, and is that supply made through that enterprise being carried on in Australia? And there's a certain other criteria which I won't dwell on today in respect of rights and options over things that would otherwise be connected with Australia, or if the recipient is an Australian consumer. Now, we'll come back to the concept of an Australian consumer when we talk about the Netflix tax, because this was added to capture GST on electronic downloads, which are intangibles, electronic downloads into Australia. So we'll come back to that as a concept a little bit later. So, if something does meet that definition, if the supply does meet that definition of a taxable supply and it has the requisite connection with Australia, then by all means it's subject to GST, unless it's GST free or input taxed. However, coming back to, sorry, if I just go back to the original, if I just go back a couple of slides, coming back to the idea of goods being imported into Australia. I said to you the goods being imported into Australia will only be a taxable supply where the supplier is registered, and keep in mind the supplier could be the non-resident. So only where the non-resident is required to be registered in Australia and that non-resident is importing the goods into Australia, or that supplier is importing the goods into Australia. Now, more often than not, that criteria will not be met. So someone sending goods or machinery or whatever to Australia, generally speaking, will not be required to be registered in Australia. They're not carrying on an enterprise here. They're not required to be registered. So it will never be a taxable supply. So therefore, you might be wondering, how in the wide world do we often pay GST on imports of goods then, if that criteria can hardly ever be met? Well, the reason why GST is often applied to imports of goods is because the supply being a taxable supply is not the only way that it can be subject to GST. a taxable importation will also be subject to GST. And a taxable importation is different to a taxable supply. Now, it is possible for a particular supply to be a taxable supply as well as a taxable importation. Obviously, it will only be subject to GST once. But a particular supply can be a taxable importation but not be a taxable supply. So it's possible, for example, that our supplier is not registered in Australia and not required to be registered in Australia, and therefore it won't be a taxable supply, but the criteria for taxable importation may very well be met, and therefore that supply will still be subject to Australian GST. Now, what it effectively means is that you don't need to be registered to have a GST liability in respect of a taxable importation. Anyone can be liable for GST on being the importer of something which meets the criteria of a taxable importation. And I'll give you a real-life example of my darling husband who got a little bit crazy on online shopping shortly. But yeah, you can find yourself being the recipient of a taxable importation, having to pay GST without being registered or carrying on any form of enterprise. Now, it doesn't take a lot to meet the criteria for the importation to be a taxable importation. All we really require is that the goods are physically imported into Australia, so they are, your tangible property has actually entered Australia, and those goods are entered for home consumption. Now, home consumption doesn't mean, for private and domestic purposes. Home consumption means that the goods are going to be consumed into Australia. So they may be imported by a wholesaler who's then going to on-sell them in Australia, or it could be a person that has imported something for their private purposes. But the idea of home consumption means that effectively the goods are proposed to be used in Australia or consumed in Australia, as opposed to entering into Australia for then perhaps being exported to somewhere else. So I like to think of it as sort of like their final destination is in Australia, and whatever their use is going to be used in Australia, whether they're going to be used to on-sell or used, personally by the party that imported them, used in carrying on their business, used by them personally. The point is they're going to remain in Australia and be used or consumed in Australia. As I say, as opposed to just entering here to be warehoused, to be transported somewhere else. So that's what entering in for home consumption actually means. So that would almost mean that pretty much anything coming into Australia, which is destined to stay in Australia in one form or another, would be a taxable importation. Having said that, there is, if the importation is a non-taxable importation, which is a defined concept, and I'll take you through what that is in a moment, then there is no GST. Now, where is here we are. Sorry, I'm doing these slides slightly out of order. I found it difficult to actually get these slides in the right order, the way that I like to talk about it. So a little bit of flicking around, but we cover all the materials in the end. Now, we have a Division 42, and there's a big appendix at the back of the full paper, which I mentioned to you earlier, that lists everything which is considered to be a non-taxable importation in Division 42. So it's a bit of a wacky list of sorts of things. It includes wacky things like calendars, catalogues, overseas travel literature, overseas price lists, other overseas printed matter, goods that are coming in that are owned by the government of a foreign country for official use in Australia, not for the purposes of trade, things relating to armed forces and armed forces agreements. Your duty-free limit falls within the definition of non-taxable importations. That's why you can bring in I think it's $900, isn't it? So I think you can bring in your $900 worth of goods without attracting GST. That's because that is written into the definition of non-taxable importations in Division 42. Now, one thing which is currently in Division 42 as a non-taxable importation is goods with a value of $1,000 or less. Now, you would all be aware that that is proposed to change. Oh, sorry, I shouldn't say that. I was about to say that's proposed to change, but the legislation has actually passed. So that legislation has actually become law, and from the 1st of July 2018, goods with a customs value of $1,000 or less will become subject to GST, but not by removing them as a non-taxable importation. Now, that becomes important because of the collection mechanism, and I'll come back to that a little bit later. But on an ongoing basis, goods with a customs value of $1,000 or less will remain a non-taxable importation, but from 1 July 18 will become subject to GST in a different way, and I'll come back to that and it'll make sense shortly. Now, other things which are not subject to GST when they come in is money, foreign currency, promissory notes, bills of exchange, etc., and things that are only temporarily coming in where security is given, which is not something you see very often. Now, the other thing which I didn't mention is up the top here, things which would have been GST free or input tax if they were supplies made in Australia, excuse me everyone, will also not be a taxable importation if they're imported. So, for example, basic food, medical aids are the common thing. If I went and bought a carton of milk from down the shops, it's GST free. If I import a carton of milk, it's GST free. So the same rules for domestic supplies in terms of what's GST free and what's input tax are replicated when we look at taxable importations. Okay, so just a brief mention on agents perhaps. Generally speaking, people, remember I said to you, it looks at the, or I should say the GST liability on a taxable importation rests with the importer. Now, quite often customs agents are used to deal with customs formalities, and the customs agent will deal with the importation on behalf of a particular customer. But generally speaking, customs broker lodge import declarations in the name of the owner or the principal that they're acting for, and therefore it's the principal which is liable for GST, even though the agent might actually pay it on behalf of the principal, but the party who's actually the importer is responsible for the GST liability. Now, I want to show this by way of an example here. Let's just say we've got, this is your Australian client here, Machine Co, and what they do is they import printing machines from an offshore supplier, and they sell it as part of carrying on their enterprise in Australia to customers, which will be presumably manufacturers or parties that provide printing services. Now, we're going to assume that our offshore supplier here is not carrying on an enterprise in Australia, not required to be registered in Australia, and therefore the supply of the machines to Machine Co is not a taxable supply. So we're going to assume that offshore not registered, and let's just say even if offshore was registered, we're going to assume that Machine Co is the importer, not the offshore supplier, which is usually the way that it works. It's the normal process, I guess. Therefore, the supply of those machines will not be a taxable supply and therefore not subject to GST. But the supply of those machines will nonetheless be a taxable importation because we've got the physical entry of goods from overseas into Australia, and they are intended to remain in Australia for home consumption, meaning that Machine Co here is going to sell them as part of carrying on their business in Australia. So therefore, it's a taxable importation. Now, when a taxable importation is made, as I said to you, the importer, Machine Co, is liable to pay the GST. And the basic rule is that Machine Co has to pay the GST to customs in order for customs to release that machinery to get it over the border, basically to release it from customs. So if you don't pay the GST, you don't actually get your goods. That's how it works with imported goods. Now, that leads to a bit of a timing problem for poor old Machine Co. So let's just assume for a moment that Machine Co is a quarterly BAS remitter. Let's just assume, because I want to create the worst case scenario for poor old Machine Co here. Let's assume that poor old Machine Co pays this GST to get these goods out of customs so they can sell them on the first day of the quarter. We'll make it the 1st of April 2017. Machiko's had to actually physically pay the cash. So it's physically handed over the GST to Customs on the 1st of April. Now, Machiko has made that acquisition in carrying on its enterprise, so Machiko is entitled to an input tax credit in respect of the GST that it's actually paid, but it doesn't get that credit until it lodges the June quarter BAS, which might be, halfway through May. So poor old Machineco's got a real cash flow disadvantage, timing disadvantage going on here, because it's paid the GST on the first day of the quarter and it's not getting the benefit of the input tax credit until 4.5 months later. So for that reason, there is a deferral scheme, which I'm just going to flick to now. There is a deferral scheme that taxpayers can apply for, which will allow them to not have to physically pay the cash to Customs to get the goods released from Customs, but Customs will effectively feed the amount of GST payable by that taxpayer into the ATO, and it will appear as a pre-filled amount into that taxpayer's next BAS. But to apply to be a deferred taxpayer, you do have to move to monthly BASs. You can't remain a quarterly BASer. That's a new word, quarterly BASer, a quarterly tax remitter. That might be a better way of putting it. Oh, Lord, maybe I should have had an extra coffee before I started. No, look, at the start I told you this wasn't going to be entertaining, but surely BASer is something that will give you a bit of a giggle. So you do have to move to monthly tax periods rather than quarterly, and you do have to deal electronically with Customs and the ATO. And that is because, as I say, Customs will pre-fill the amount of GST that you didn't pay when you took the goods into your next monthly BAS. Sometimes if the amounts are large, the Commissioner might require a bank guarantee before they sign off that you are an approved deferred taxpayer. There is a process you have to go through to apply to be a deferred taxpayer, and Customs is notified that you are an approved taxpayer, such that when you do make an importation, you can have the goods released without paying the GST at that time. And that does away with the timing disadvantage that you might otherwise experience, that a taxpayer might otherwise experience. Now, how do we calculate the GST on a taxable importation? Well, it's not just on the Customs value of the goods. It's the Customs value of the goods plus a whole heap of on-costs, international transport costs, insurance, handling, customs, etc., etc. Now, let's just assume that your client is not a deferred payer. Therefore, they want to pay the GST at the time, or they have to pay the GST at the time the goods are released from Customs. They might not be able to quantify some of these on-costs. And therefore, there was a new rule introduced from 1 October 16 that the ATO will accept an additional 10% of the Customs value on top of the Customs value as a proxy for all of those on-costs, and they will accept that if GST is paid on the Customs value plus another 10% of the Customs value, they will accept that the appropriate amount of GST has been paid. So that should make it easier for non-deferred taxpayers, or in fact even deferred taxpayers can calculate using that method, but at least we don't have to wait around for final bills in relation to all these on-costs before the GST can be paid and the goods released. Okay, already done. Some of these slides I've already talked about, even though I wasn't very good at actually moving the slides. Now, in respect of claiming an input tax credit for GST paid on taxable importations, generally speaking, the same rules around ordinary input tax credits apply. So if the entity that is the importer is registered for GST and they import the goods solely or partly for a creditable purpose, and the importation is a taxable importation, then they're entitled to an input tax credit. So generally speaking, the regular rules apply. Now, before I move off the importation of goods, I do want to talk to you about low value goods, because I mentioned them before. I said to you that goods with a Customs value of less than $1,000 are currently a non-taxable importation. But from 1 July 18, they will be subject to GST. Now, some of you might be thinking, oh, gee, I thought that date was 1 July 17. It was originally in the original version of the legislation, but the final version of the legislation that got royal assent did defer the start date of these new rules to 1 July 18. So that's not a misprint, it is the correct date. Now, if given what I've just taken you through in terms of paying the GST on a taxable importation, if low-value goods were just removed from the definition of a non-taxable importation, then they would just be normal taxable importations. And that would require you and me to be running down to customs to pay the GST on our very, very small importation every time we imported something. So imagine you went onto eBay and bought a $10 iPad cover. You wouldn't be able to get that directly delivered to your door. You would actually, that would have to get held up at customs, which for all practical purposes is effectively the post office, until you go down there, pay the GST, and then they'll release the goods to you. Now, that is obviously unworkable from a domestic perspective when you think about all the thousands of things, items, goods, which people import with a value of less than $1,000. But that would be how it would have to work if we removed low-value goods from the definition of non-taxable importations. And for that reason, goods with a customs value of less than $1,000 will actually technically remain after 1 July 18 a non-taxable importation, and instead there's a completely new regime that has been introduced to deal specifically with goods with a customs value of less than $1,000 to give a different collection mechanism. So instead of you or I being the importer running down and paying the GST, the offshore supplier that facilitates the transport of those goods to Australia is responsible for charging the GST, collecting it from you and me, and then remitting that to the ATO. So if I, for example, bought myself a lovely pair of $700 shoes, I wish, from some beautiful French or Italian department store, they should, if they are applying Australian GST rules correctly, they should in fact charge me $770. They should remit the $70 of GST to the ATO, and my shoes will be delivered straight to my door because I paid the GST through the purchase process for the shoes. Now, Michelle's just sent me a message saying, lucky girl. I did say I wish, Michelle. I don't actually have spare $700 to blow on a pair of shoes, but I do wish. Otherwise, if we didn't have a separate regime, we'd be in a situation like my darling husband, who I told you earlier I was going to use as an example. A couple of years ago, he got a little bit trigger happy on a UK shirt warehouse website. He loves this particular brand of shirts from the UK, and they had a massive sale. He got a bit trigger happy on the quantity button, bought so many shirts that went to over $1,000 Australian dollars. Putting aside the fact I nearly killed him for that reason on its own. He then wondered a few weeks later why his shirts hadn't been delivered. Then we get a letter from Australia Post or from Customs saying that the goods are being held in customs until he comes down and pays the GST. Now, that didn't require us going to the local post office. We had to go to one of those big industrial sort of post offices. It was about 10 k's away, stand in this massive line, pay the GST, which he was a bit narky about having to do before the shirts were released. And as I say, that would be the implication if low-value goods became a taxable importation. So instead, as I said to you, they'll remain non-taxable. You pay it at source. The ATO's collection issues will be with the non-resident supplier, not with us consumers. Okay, now the easiest part of this paper, moving out of the importation of goods, we're now moving to the exportation of goods, which, as I just mentioned, I think is probably the easiest part of this paper. Now, if we were to go back to what we talked about at the very beginning, and when we talked about taxable supplies, I said to you that the removal of goods from Australia will generally have a connection to the indirect tax zone and therefore will generally be a taxable supply. However, the policy that underlies GST is that it should only be applied when the consumption of the goods is in Australia. And therefore, by definition, if you are exporting goods, the consumption of those goods is not going to be in Australia. And for policy purposes, they said, Treasury, at the time they drafted these rules, said GST should not apply if the goods are being removed from Australia. So what we have is some special rules that decree when the export of goods will be GST free. If you don't meet the criteria for the goods being GST free, then the export of goods will be a taxable supply. Now, it's not very hard to meet the criteria. Typically, there needs to be a supply of goods. They need to physically leave Australia, and the physical leaving of the goods from Australia needs to be done within a specific time frame. Now, that specific time frame is technically 60 days from the earlier of when consideration is paid for the goods or the invoice for the goods is issued. I would have thought in most cases the invoice would come before payment, so I suspect the earlier of those two dates will typically be more the invoice date rather than the payment date, and from 60 days after that, the goods technically need to leave Australia. Now, when I say leave Australia, I mean leave the indirect tax zone as it's defined, which includes Australian territorial waters or certain Australian territorial waters and the like. Now, practically it's a bit difficult for people to know exactly when their goods have left Australian territorial waters. You might know when your ship is leaving port, but you won't necessarily know when it's left Australia as defined. So the ATO takes a very, well, I shouldn't say relaxed approach, but the ATO does pretty much take the approach that as long as the goods effectively have crossed the customs barrier within that 60-day time frame, then broadly the ATO will accept that the goods have been exported within the appropriate time frame. Obviously, if your client is flying the goods out, it's much easier to tell whether you're within the 60-day time frame or not. It's a bit harder when we're looking at shipping. Now, just coming back to the slide before for a moment, it does, one thing I would say about exporting goods, that it is important to keep the required documentation to show that the supplier exported the goods, or an agent on behalf of the supplier who's acting as an agent for the supplier, but the supplier who's registered for GST must be the exporter of the goods. So we need shipping documentation and other customs documentation and international transport documentation that shows it's the Australian registered supplier who's exporting the goods, or as I say, the agent on their behalf, and show that at least across the customs barrier within the specified time. So I think we've talked about that. We talked about supplier exporting the goods. We're talking about taking them out of the country, removing them from Australia. Yeah, I think that's. I think we've talked about everything on that slide. And I've said to you, as long as the export, if it is carried out through an agent, as long as the agent is acting on behalf of the resident GST registered supplier, then the criteria will still be met. As I understand it. And I'm happy for you guys to correct me if you feel otherwise, but as people have explained to me, most exports, so to speak, or most Australians that export aren't necessarily exporting themselves. I know in respect of oil and gas and things like that, the Australian entity is typically exporting, but apparently when it comes to a lot of primary production, typically your primary producer is not actually doing the exporting. Typically your primary producer is apparently more often than not selling to a broker of some description, and it's the broker that then, you know, exports. If the primary production goods are actually going to be exported, it's usually the broker that's exporting them in their own right, not necessarily on behalf of your primary producer. So your primary producer may actually just be making a regular taxable supply to another Australian entity of goods wholly within Australia, and it might in fact be the broker that's in fact doing the exporting. So it's important to understand who actually owns the goods at the time they're exported and who's actually doing the exporting. Okay, so I think we've already talked about documentation requirements there. Now, this is where it starts to get juicy. This is the third of the four parts of this paper, but this is where it gets a little bit more complex than importing and exporting goods. Because as I said to you, goods, the importation and exportation of goods have their own categorisation or have their own set of rules, but when it comes to intangibles or services, there's a completely different set of rules that you need to look at. It's not the same as the rules around goods. The rules around goods I find easier, and I find them easier to explain to people rather than the goods around the supply of services or intangibles to non-residents. Now, I do find that accountants like this particular section because accountants like to all think about this section in the context of their own advice. Oh, our advice is a service or an intangible, and sometimes non-residents do ask us for advice, and we always find it a little bit tricky to ascertain whether we should be charging them GST on our bill in respect to the advice or whether we shouldn't be. So this affects anyone, as I say, that's providing services or intangibles to non-residents. And sorry, not just non-residents, but some categories deal with non-residents. Some deal with services or intangibles being supplied to parties outside of Australia, whether or not they're in fact resident. So as I say, you know, any accounting advice, legal advice, valuation advice, property management services, engineering services, any sort of consultants that provide, you know, their services to non-residents all fall within this area that we're just about to talk about now. So outbound, the supply of outbound services or intangibles. Now, the rules around outbound services or supplying outbound services or intangibles are broadly in concept the same as exporting goods. Now remember I said to you when we talked about exporting goods that the general policy of GST is that it should only apply where consumption takes place in Australia. So if the goods physically leave Australia, consumption of those goods is outside of Australia, so you know where the criteria is met, that supply can be treated as GST free. Well, the same concept applies to services in intangibles. Although something might be supplied from Australia, if the consumption, so to speak, of that service or intangible is outside of Australia, then it should also be GST free. Having said that, you do need to meet one of these 5 items here. And you'll see where I'm moving my red ball around. There's 5 ways, 5 items within the GST Act that specify when the supply of a service or intangible to someone outside of Australia is GST free or not. The most important ones are 1, 2 and 3, and we're going to focus our time on 1, 2 and 3. 4 and 5 deal with rights, which I won't go through in as much detail, and 5 deals with the export of services in relation to repairing imported goods. So the common example of item 5 is a ship or a plane comes into Australia. It needs a repair, so someone in Australia does a repair on the ship or the aircraft on behalf of the non-resident owner of the ship or the aircraft, and the ship or the aircraft then leaves Australia again once it's repaired. That can be GST free under item 5. So I won't really go through items 4 and 5. I'm going to focus on 1, 2 and 3 because that deals with the vast majority of your clients. But if you don't meet the specific criteria for items 1, 2 and 3, then the supply will not be GST free. Now, I'll just briefly mention what 1, 2 and 3 are, and then I'll take you through some exceptions to GST free treatment, but then I'll go through them in a little bit more detail with some examples. So, if a supply made by someone in Australia is connected with property outside of Australia, then it can be GST free. And I'll go through these in more detail in a minute. If a supply is made to a non-resident who's physically outside of Australia, then that can be GST free. And thirdly, if the supply is used or enjoyed outside of Australia, that can be GST free. Now, although that's the general rule, there are certain exceptions, and these are some exceptions, and if we meet the criteria for these exemptions, then the supply will not be GST free. So if the supply is of a right or an option to acquire something which would be connected with Australia, it won't be GST free. In relation to items 2 to 4, which for our case is really just 2 to 3, so basically supplies made to parties using the supply outside of Australia, that will not be GST free if the supply in any way relates to real property situated in Australia that would be wholly or partly input taxed. So, for example, if you give some advice to a non-resident about their residential investment property in Australia, that's real property situated in Australia, and the real property would be input tax because it's residential, therefore your advice will not be GST free. And in relation to supplies made to non-residents outside of Australia, if that's made under an agreement entered into with a non-resident, but the supply is to be provided to another entity within the indirect tax zone, that is potentially not GST free unless the other entity is a business entity that could claim an input tax credit. So we'll go through that in a little bit more detail shortly anyway. So let's start with item number 1. So a supply directly connected with goods or real property located outside of Australia will be GST free. Now the tax office requires there to be a very close link or a very close connection between the supply and the goods or the real property outside of Australia in order for the supply to be GST free. So it's got to change or affect the goods or real property in a physical way. So you're doing something to them, like so maybe doing a renovation or something like that. It establishes the quantity, size or other physical attributes or value of the goods or real property outside of Australia, or affects ownership of the goods or real property outside of Australia. So having gone through that, our next slide is a quick quiz that relates to the giving of tax advice in relation to property outside of Australia. So Jamie, your resident client, owns real property in the UK. Jamie asks you to provide advice on the UK and Australian tax implications of selling this property. Jamie is in Australia when you prepare the advice. Is this supply GST free under item 1? And just to remind you, item 1 is a supply directly connected with goods or real property outside of the indirect tax zone. Vote A for yes, as the real property is outside of the indirect tax zone. Vote B for no, as the supply is not directly connected to real property outside of Australia. Vote C for no, as Jamie is a resident and in Australia at the time the advice is given. Or D, not sure, this area of GST is really tricky. So guys, I understand that these, a lot of people will get these quick quizzes wrong. The whole idea of these quick quizzes is for us to learn from them. So even if you don't exactly know what the answer is, have a go, press the submit button, and I'll talk you through these items after you've put in your responses.
There are only a few answering so far. I need to wake the rest up. I think they're okay, coming in thick and fast now.
It's not an easy area, Michelle. You've got to be kind to us today. She's very bossy, that Michelle, isn't she? She demands instant response. It's tricky. We need time.
Tricky. Okay. 60% in. There's just one person or two people. If they could just click their submit buttons, then we'll be there. Okay, it's closed up now. All right, majority of people went for C.
I knew that was going to be the case, which is actually not the correct answer. Okay, guys. 9% of you went for A, 27% of you went for B, which was actually the correct answer, and 64% of you went for C, which is because Jamie is a resident and in Australia at the time the advice is given. Now, although C is intuitively, this is what I said to you earlier about how a lot of this is quite counterintuitive. I knew that most of you would go for C, which is why I put it there as an option, because it just feels like it's the right answer. Or how could it be GST free if I'm giving advice to someone in Australia who's here? And it is possible that that would be a problem under one of the other items. But item 1 is only about whether supply is directly connected with goods or real estate outside of Australia. So if the advice was directly connected with Jamie's property outside of Australia, it doesn't matter that Jamie is actually a resident and that Jamie is here, which is why C is the incorrect answer. But B is the correct answer because the ATO is of the view that giving advice in relation to property outside of Australia, general advice like legal advice or tax advice, is actually does not have a direct enough connection to real property outside of Australia. It's got to be something more directly connected. So they'll accept that valuing a particular property is that's outside of Australia has a direct connection. If you're physically doing anything to it, constructing it, altering it, repairing it, installing it, cleaning it, modifying it, repairing, maintaining it, then that counts as a direct connection. If you're providing property management services directly to that particular property, then that's fine as well. But giving advice in respect of a property outside of Australia, irrespective of whether the recipient is in Australia or not, is not actually, in the eyes of the ATO, directly connected to property outside of Australia. I don't actually agree with that, but it doesn't really matter what I think. The ATO thinks that advice, which is what most directly affects you guys, does not have the direct connection. So it's possible that your advice to your client is not GST free under item 1, but it may very well be under item 2. Now, item 2, it doesn't matter which one of these items you satisfy, as long as you satisfy one of them, the supply can be treated as GST free. Now, item 2 says that if the supply is made to a non-resident, so in this case the other party does have to be a non-resident, whereas it didn't in item 1. So to satisfy item 2, the supply must be made to a non-resident who's not in Australia when the thing supplied is done. The supply also can't be of work physically performed on goods situated in Australia when the goods are done, when the work is done on the goods. It can't be a supply directly related to real property located in Australia. Or if the non-resident acquires the thing in carrying on an enterprise in Australia, that also will not be GST free. Now, if the non-resident is actually in Australia when the thing is done, that doesn't necessarily mean that it's not going to be GST free. It depends on why they're in Australia. If they're in Australia in relation to the supply, then it will not be GST free. But if they're merely here for some other reason, it won't necessarily mean that it's not GST free. So meaning if I'm a non-resident and you guys gave me some advice and I happen to be here in Australia on holiday when you press the send button on your advice, I'm not here in relation to the advice that you're giving me. I'm here because I'm snorkeling up on the Great Barrier Reef on a holiday. It would still mean that the advice that you guys give me could be treated as GST free. But if I physically flew in here to have some meetings with you to talk about this very complicated tax advice you're giving me, and I stayed in a hotel around the corner from your office for 3 days while we worked through the different tax issues, then I am physically in Australia in relation to the supply, and therefore that supply would not be GST free. So it can be here, but not here in relation to the supply. So with that takes me to our next quick quiz. Lucy is your non-resident client and she owns real property in Australia. Lucy asks you to provide some advice on the tax implications of selling the property in Australia. Lucy is not in Australia when you prepare and provide the advice. Is this supply GST free under item 2, which, just to remind you again, is a supply to a non-resident who's outside of the indirect tax zone? So vote A for maybe. It depends on if the real property is commercial or residential. Vote B for no, as the supply relates to property located within Australia. Vote C for yes, as Lucy is a non-resident and not in Australia at the time the advice is given. Or my standard old D, not sure this area of GST is too tricky for me. So guys, cast your vote, press that submit button, and I'll talk you through the options because I'm pretty sure we'll probably get another mixed bag of responses. Excuse me. How are we going for responses, Michelle?
Yeah, just a few people, one person, if they could just click the submit button, that would be great, thank you. Unfortunately, some of them responded a bit too late. So just at the moment, you've got 40% against B and C and 18, no, actually it's coming back slightly differently, 45% against C, 36 against B, and 18 against A. So yes, we do have a mixed bag. I'll pop those up shortly.
Okay. Well, the correct answer was actually A. And only 18% of you went for A, and part of that 18% was actually me. So the real response to A was actually lower. Now, the most of you went for B or C. Now, if I go back to the wording of item 2, it just requires a supply to be made to a non-resident who's not in the indirect tax zone when the thing is done. So I'm supplying it to Lucy, she's a non-resident, and she's not here. So I can understand why 45% of you went for C, because it looks like she meets the criteria. Yes, it's GST-free, Lucy's a non-resident, she's not here. Of course it's GST-free. But the real answer is actually A, because remember I said to you there's an exclusion when it comes to real property located in Australia if the real property is input taxed. Now, and I didn't say what the answer didn't say whether Lucy's real property was commercial or residential. So the reality is if Lucy's property is commercial, then it is GST-free because it's not input taxed. But if Lucy's property was a residential investment property, and of course residential properties are input taxed, then that negates the GST-free treatment. So the answer is A. Now, it doesn't matter. For the 36% of you that went for B, you thought, no, it's not going to be GST-free because the property is located here. That doesn't matter. It doesn't matter the property is here. It's just the supply is the advice. The supply that you made was giving your advice. You gave it to Lucy, who's not here, which makes it GST-free. But, as I said, the only thing that can negate that is if the property itself is input taxed. So it doesn't matter if the property is here. What does matter is whether it's commercial or residential. So that's why I said to you guys, this is a really tricky area, and you're not going to remember. As I said to you, if I came back, if we did a rehash of this session tomorrow and I did all these quick quizzes, and I'll say I had different variations of them, you'd probably still all be getting them wrong. It's one of those areas of GST where unfortunately, you just need to spend the time working through the provisions as and when these sorts of issues arise. Now, there's something else I need to talk to you about in respect of item 2. So we go back to item 2, supply made to a non-resident who's not here when the thing is done. That's your basic rule. But let's just say the contract is with the non-resident, but the contract with the non-resident requires you guys to do something, or requires the Australian supplier to do something or provide something to another entity in the indirect tax zone. Then that possibly negates the GST-free status. So my contract is with the non-resident, but the non-resident says, yeah, but give your advice or give your contracting services or your consulting services or whatever it is to someone who's in Australia, another entity in Australia. That means it won't be GST-free unless the other entity in Australia is registered for GST. So I'll take you through an example of that. I decided not to do this one as a quick quiz. I thought that might throw you all over the edge and everyone would start instantly leaving the session. So I thought I'd make this one just a general example. So we've got Eagle Co., a non-resident US parent company that contacts you guys, an Australian accounting firm. You are now Felsted, an Australian accounting firm, for you to provide audit services to its subsidiary in Australia. Now, Eagle itself, who you are contracting with, doesn't carry on a business in Australia. It doesn't have a place of business of its own. It doesn't have an agent acting on its behalf. So the parent company itself has no presence here. You are contracting with the parent company. And obviously what you're supplying is the supply of the service. But you are physically providing the service to the Australian subsidiary so that it can satisfy its regulatory obligations in Australia. So contractual flow is between you, the accounting firm, and parent company, but the actual flow of services is here to another entity within the indirect tax zone. So where the contractual flow is to the non-resident, but the non-resident has actually asked you to make the supply to someone in Australia, that would not be GST free. But in our case, because the Australian subsidiary is in fact registered for GST and is carrying out an enterprise in Australia, it's an Australian-based business recipient of the supply, then it actually preserves the GST treatment under item 2. But if for example, if Australian, I don't know, I'm just going back here, if AusSub had been an entity not carrying on an enterprise in Australia and not registered for GST, not carrying on a business, like let's just say that was a passive investment vehicle that was investing passively, not carrying on an enterprise, not required to be registered, for example, then that would actually not have been GST free. So that's an example of supplies being made to Australia where the contractual flow is outside of Australia. Now, the third and last likely item, as I say, there are 2 more, but the third, item 3 is the last likely item that might give you GST-free status, is item 3. Now, item 3 will give GST-free status to a supply made to a recipient. Now, keep in mind it does not say non-resident recipient, it just says any recipient. Made to a recipient, resident or non-resident, who's not in Australia when the thing supplied is done, and the effective use or enjoyment of the supply takes place outside of the indirect tax zone. Now, there are some exclusions. Again, if it's the supply of work physically performed on goods or real property located in Australia, then it's excluded. I guess that would be obvious anyway, because the use or enjoyment is probably not taking place outside of Australia if the goods or the real property are here. Now, again, not in the indirect tax zone means not in relation to not in Australia in relation to the supply. And as I mentioned to you, it doesn't matter whether the recipient is resident or non-resident. It just matters that they are outside of Australia when the supply is done, and they have got effective use or enjoyment of that supply outside of Australia. Now, I think what we might do is go to this quick quiz, which will illustrate the point. Now, the tax section of your firm has had a record-breaking year, and to reward all employees of the tax section, all the employees will be flown to a luxury resort in Tahiti to enjoy some team bonding time. To ensure that the employees don't completely forget the important aspects of the Income Tax Assessment Act while in Tahiti, you've engaged TaxBad to send Deb Giuliani over to Tahiti to deliver a half-day training seminar, tax training seminar. Is this supply GST-free under item 3, i.e. a supply used or enjoyed outside of Australia? Now, vote A for yes. Sorry, not just yes, definitely yes, as all employees enjoy Deb's training which has taken place outside of Australia. Vote B for no, as the supply is being made by a GST registered entity in Australia, i.e. tax data. Vote C for no, as the supply is being made to a GST registered entity in Australia, i.e. your firm. Or vote D for, again, I'm just not sure, it's all too hard. So don't forget to press that submit button, everyone, and that will record your choice. This particular quick quiz was about as entertaining as I could make today's presentation.
You've done well, Deb.
I really liked it. I really want it to come true. No one's ever asked me to give a presentation outside of Australia. Tahiti would be magnificent.
It would be awesome.
It's only a half-day seminar. We could enjoy the pool, the beach afterwards, cocktails. It'd be lovely.
It's just one person. Okay, I'm closing the poll now, and I'll be able to pop those results up for you right now. There you go, Deb.
No problem. Okie dokie. Well, the 42% of you went for A, definitely yes, and you guys have got it. That 42% of you is correct. Now, also 42% of you went for B, which I understand. I can understand it feels wrong. You've got a supply being made by a GST registered entity in Australia. You've got a supply being made by tax banter to a recipient that's carrying on enterprise in Australia and is GST registered in Australia. So you're registered for GST in Australia, the supplier is registered for GST in Australia. How can that possibly be GST free? Everyone says to me. I say, well, it is because the employees are not physically in Australia when the supply of the thing is done. The supply of the thing is my training session. You're not physically in Australia when the thing is done, and you have got effective use and enjoyment. Hold on, there we go. You are effectively using or enjoying my supply outside of Australia. Bam, GST free. Now, before I go into the rest of this part of this paper, I will say that most people, particularly once I've done item 3, just go, Deb, I've heard everything you've said. I understand that, the use or enjoyment's outside of Australia, it's GST free. The recipient's not in Australia at the time the supply is made to them, it's GST free. I get all of that, Deb, I understand. However, it just doesn't feel right, and unless the non-resident complains, we will always charge GST on these sorts of supplies. And people tell me that all the time. And the reality is that, I guess that is a safe option. The reality is that if an Australian supplier has treated something as GST free when they shouldn't have, then of course there are penalties that can be levied if you've got it wrong. So I understand that it's more conservative and it feels better for you internally to charge GST on these sorts of supplies, and if the non-resident's not going to complain, then so be it. And people tell me all the time, non-residents have got no idea about how Australian GST works, so they just pay it, they very rarely complain, and it makes you feel better. And I understand, the ATO's not going to be upset with you. They're going to be happy. You've charged GST and remitted GST when you don't have to. And that's all fine. But if you didn't want to, if the non-resident understood Australian GST and understood that some of these sorts of supplies are actually potentially GST free, then you might need to look into this a bit more closely. Okay, so we did that quick quiz. So item 4 and 5 I won't go into a lot of detail, but as I said to you, item 4 looks at a supply made in relation to rights. If the rights are for use outside of Australia and the supply is to an entity that's not an Australian resident and is outside the indirect tax zone when the thing is done. We did have a case in respect of that. We did actually have a High Court decision on that. It wasn't very relevant although it was a High Court decision, I wasn't really going through it in updates when it was relevant because it related to the supply of foreign currency by a foreign currency provider on the other side of the customs border in relation to whether the supply of, it was actually Fijian currency, 400 Fijian dollars, whether the supply of 400 Fijian dollars was in relation to rights for use outside of Australia, which would have been GST free, because I said to you, the supply of rights for use outside of Australia, GST free. And the High Court said yes, it was. But it was a complicated case about whether foreign currency, when you were supplied with foreign currency, was that a right or was it something else? But it was held to be a right. It was a right to use that currency in another country and the right for you to buy things with using that currency, and therefore it was GST free under item 4. So intellectual property rights, insurance, etc., are all considered to be rights that could be provided GST free if they're provided to someone outside the indirect tax zone. And item number 5 is what I mentioned to you earlier, is pretty much relates to the repair, renovation, modification of treatment of goods that have come into Australia from outside of Australia, whose destination is going to be outside of Australia. And as I said to you, repairs done in Australia on ships or aircraft that have come into Australia, need a repair and are going to fly out or drive out or ship themselves out again. So I won't spend a lot of time on that one. Now, our 4th and final section of this paper relates to acquiring services or intangibles from offshore. So rather than providing the services, advice, whatever from offshore, you are acquiring it from offshore. Now, like the importation of goods, so if we ignore taxable importations and go back to the basics around taxable supplies, like when we look at whether the importation of goods is a taxable supply, it's unlikely to be. If I was to go back to one of the very first slides and we were to look at, you know, whether the importation of supplies of goods or services have got the necessary connection to Australia, they generally won't where the service is being performed outside of Australia or where the advice, information or intangible is being provided from outside of Australia. So generally speaking, the supply by non-residents of services or intangibles will generally be outside the scope of GST. Generally won't be a taxable supply and generally not be subject to GST. However, and typically also the non-resident supplier is usually not required to be registered in Australia unless they're carrying on enterprise here. But for example, if I am Apple Music, and I'm making this up, if I'm Apple Music and my servers and my distribution platforms and stuff are all outside of Australia, if an Australian person comes and downloads music, then there's no enterprise being carried on in Australia. There's nothing here in Australia for GST to be applied to. Now, there is one exception to that general rule, which is that there is no GST, and that's if the reverse charge rules are triggered. Now, I'm not going to go through the voluntary reverse charge rules because generally speaking, people don't voluntarily pay GST unless they have to. But what I will go through is the mandatory reverse charge rules, because in this case, you will have to pay GST if you fall within the reverse charge rules. Now, the reverse charge rules basically say is that when you acquire a service or intangible from offshore, but you haven't acquired it solely for creditable purposes, then you need to apply the reverse charge. Now, what that means is this. So let me, let me give you an example. Let's just say that this is an example that I want to give you that relates to before the Netflix tax was introduced. So before the Netflix tax was introduced, let's just say I was a GST registered sole trader plumber, and I decided that I need some new bookkeeping software or some new accounting software. The business has grown a lot. I've got to do a lot more invoices than I previously had to do. BAS is getting a bit trickier. There's just more record keeping I have to do. I think I need a better software package. So I go online and I download an accounting package from Offshore, and I pay however much. I pay my 1,000 Australian dollars for this software. Now, if that software is being 100% used, is being used solely for creditable purposes, so I'm solely using that to deal with the administrative and paperwork aspects of my plumbing business, then the reverse charge mechanism will not apply. But let's just assume that that accounting package has also got a personal budgeting module, and I think I'm going to use that for my personal family budgeting purposes as well. So let's just say the acquisition is 80% creditable, but 20% is for private and domestic purposes, which means that the acquisition is not solely for creditable purposes because it's less than creditable it's less than 100% being used for creditable purposes. So therefore, the reverse charge mechanism kicks in. And what that requires me to do is to, me as the recipient, actually pay the GST under the reverse charge and then claim an input tax credit, but only up to the percentage of the GST that I'm eligible to claim the input tax credit for. So let's just say my download of this software is for $1,000. So I will actually show in my next BAS GST of $100. So 10% of the purchase price, not 1/11 of the purchase price. And then I will claim an input tax credit for $80 in the same BAS. But if I was using it 100% for creditable purposes, I don't need to do anything. I don't need to include the $100 in my BAS, and I don't claim an input tax credit for $100. The reverse charge mechanism is just not triggered because I will be using it solely for creditable purposes. I don't think, just between you, me and the gatepost, that there is an enormous amount of, let's just say, compliance with the reverse charge rules. I strongly suspect that pretty much everyone probably makes all of their downloads and makes all their acquisitions of services or intangibles 100% for creditable purposes. The reverse charge obviously doesn't apply to fully creditable acquisitions, as I just said, or if the supplier is GST free or input taxed. So only if it would be a taxable supply, if it was made locally, I guess. So I've already said to you the GST is 10% of the 10% of the price of the supply, not 1/11th, and you can claim GST credits up to whatever threshold, up to whatever percentage you should be. Now, our final example for today, and I'm mildly concerned that it's only 10 past 12 and we're on our final few slides, so I'm seriously hoping that you guys have got a lot of questions for me. Otherwise, we're not going to get to 12:30 and you'll feel I've ripped you off some GST. But anyway, this example which I'm going to go through here goes through something which we call the extended reverse charge. Now, the extended reverse charge is basically the Netflix tax. Now, you will have heard everyone colloquially refer to the Netflix tax as the Netflix tax, but technically it's a tax, it's the imposition of GST on downloads downloads of anything digital from an electronic distribution platform. Now, it isn't just Netflix movies, even though we call it the Netflix tax. It's software, it's music, it's films, it's games. I always forget to say games. Anything now, and when I say now, what I mean by that is from 1 July 17, anything that is downloaded by an Australian consumer. You might remember way back at the start I mentioned Australian consumers. And Australian consumers are now subject to Australian GST where they download these digital products. An Australian consumer is a defined term. It's an Australian resident who is either not registered for Australian GST, or if they are, the download is not in relation to their enterprise. So our GST registered plumber, which I mentioned to you, when he downloads a movie on Friday night, he is GST registered, but downloading the movie has got nothing to do with his plumbing enterprise. It's just him downloading in his personal capacity. And therefore, he is an Australian consumer, and therefore he will be subject to Australian GST when he downloads that movie. Now, again, the compliance and obligations around charging and collecting the Australian GST on these electronic downloads rests with the non-resident operator of the electronic distribution platform. So it's Netflix, it's Apple, it's Xero, if it's accounting software, for example. Whoever is actually operating the platform from which you are doing the download is responsible for charging Australian GST if the recipient is an Australian consumer. So that recipient has to ask, that provider, rather, the supplier, needs to ask enough questions of you or me when we subscribe for that download to ascertain whether or not we're an Australian consumer or not. Now, the ATO issued a law companion guide a couple of months ago on this to give guidance to non-resident operators of electronic distribution platforms on how far they had to go in order to ascertain whether I was correctly an Australian consumer or not. And I won't go through that because unless you've got clients who are non-resident operators of electronic distribution platforms, you'll never really have to give that advice. But broadly, they need to ask enough questions and have robust enough systems to make at least an educated, or to at least, I won't say an educated guess, that's not the right word, but make an educated decision on whether I am correctly an Australian consumer or not. It can get confusing when, I put my name and I put my address in Australia, but then I use a UK credit card to pay because I previously lived in the UK or something like that. Then, how does Apple know whether I'm an Australian resident or a UK resident? So it gives guidance to non-residents in respect of that sort of stuff. So, back to this example. Leslie is an Australian resident individual. She carries on a farming business as a sole trader and is registered for GST in respect of her farming business. In mid-2017, Leslie acquires a number of digital products. None of these supplies are made in Australia or through an enterprise being carried on in Australia. Now, on the 14th of July, which I might add is after the 1st of July, 2017, Leslie acquires music from Online Music Co. for a wholly private purpose. Leslie is an Australian consumer in respect of the supply because, of course, even though she's registered for GST, this download of music has got nothing to do with her primary production enterprise. She correctly does not provide her ABN, and she doesn't declare that she's registered for GST in the course of this transaction. As a result, online music company should be charging her the GST. So Leslie pays it, and it's the ATO's problem to go ahead to deal with the problem of trying to collect GST from Online Music Co. The whole idea of these rules was to put Australian electronic distribution platforms on the same footing as non-resident electronic distribution platforms. Now, on the 3rd of August, 2017, Leslie acquires software from online software company for a partly private purpose. So she's partly going to use this software in her enterprise. She's partly going to use it for private purposes. Now, as she did acquire the supply partly for the purpose of carrying on her enterprise, she's not an Australian consumer in respect of this transaction. So therefore, online software companies should not be charging her GST, and she should quote her ABN, and therefore they won't charge her GST. But the general reverse charge rule will kick in, which is what I talked to you about before. She needs to show she needs to pay 100% of the GST on, she needs to, I guess, declare 100% of the GST in her BAS and then claim an input tax credit up to, or only up to, her credible purpose in respect to that acquisition. Now, on the 6th of September 2017, Leslie acquires a movie from Online Movie Company for a wholly private purpose, but, excuse me, Leslie incorrectly provides or gives her ABN. Sorry guys, I had a bit of a tickle in my throat. I had to take a sip of water. But Leslie incorrectly gave Online Moving Company her ABN and declared that she's registered for GST. So poor old Online Moving Company is in a bit of a dither because she's declared that she's not an Australian consumer, but of course she actually is. So Online Moving Company determines that she's most likely not an Australian consumer, which is fair enough for Online Moving Company. They don't know Leslie, and they don't know that she's incorrectly, either accidentally or purposefully, used her ABN to avoid GST. But either way, Movie Company hasn't applied GST. Now, Online Movie Company, because it has asked the appropriate questions, even though it hasn't treated Leslie as an Australian consumer when it should have, but effectively, the problem from a GST perspective is actually not with Online Moving Company. The ATO would be satisfied that Online Moving Company has asked enough questions to reasonably believe that Leslie is not an Australian consumer. Therefore, the ATO will not go chasing Online Moving Company for having made the wrong decision. Instead, Leslie will be subject to the extended reverse charge, meaning that Leslie should, in fact, because this was a wholly private purpose, should actually show 100% of the GST in her BAS and effectively pay it by lodging her next BAS. So by doing this way, I guess she's got a timing advantage because she's not actually paying this GST when she downloaded the movie. She's going to pay the GST when she lodges her BAS, but the reality is that she should never have declared her ABN in the first place. So the GST liability in this situation rests with Leslie, not Online Moving Company. And that, guys, is the end of today's session. It's only 12:18, so I have well and truly ripped you off 12 minutes of valuable GST information. So I'm more than happy to stay online and answer any questions that you might have. I appreciate the fact that half of you might in fact be asleep now. I tried to make it as exciting as it is, but it's not, sometimes the material doesn't work in my favour to make it overly entertaining. But as I said to you earlier, guys, the paper itself is a very, very good reference tool. So please save the paper somewhere on your computer system. Use it as a good reference tool, and as I say, it's broken up into those 4 sections, and it does give you all the section references and all the, gives you the methodology on what you have to go through to ascertain whether the supply or the acquisition is subject to GST or not when it comes to imports and exports. And that's all I've got, Michelle. I'm sorry I finished early.
Hold on 2 seconds. There's a question here that I see Lisa just sent to all attendees. Hold on and I'll pop it through.
Okay,
I'll just read it out to you. You got that?
No, I haven't.
No, I don't think so. All right, hold on 2 seconds and I'll just copy it across from my control PC for you. I've just seen that, so I'll just pop that in there.
Thanks, Michelle.
That'll at least give you one question to answer there.
Okay, I've got it now. Why did I get it if I'm on an attendee? Oh, I'm not an attendee, am I? I'm a panellist. Okay, I understand why I didn't get it now.
To all participants, you see.
Yes. Lisa, I have a situation where a company receives commission income for sales of plant from a foreign entity. Do you consider this service GST free? So, Lisa, so your client is a company, and what actually does it do? It sells plant on behalf of a foreign entity. Obviously, I know it's receiving the commission income from the sale of plant from a foreign entity, but what actually is the supply which your company client is making, and to whom are they making it? Because what you have to do, the first part in all of this is to ascertain what actually is the supply. But what does it do to get its commission, Lisa? What's its supply? I mean, it's not being paid commission for nothing, presumably. And if it is, how do I get that myself? Wouldn't mind someone paying me commission for nothing. It must be doing something to get its commission. So is it selling its own goods, or is it just providing, like I guess right? So it's the goods of. Sorry, just so I understand, Lisa, it's perhaps the plant owned by the foreign entity, which your client is providing a sales service for and receives a commission on selling those goods. Okay, yeah, understand. Okay, so it is like a sales service. Okay, yep, good. It's a sales service being provided to contractually a non-resident, but the service, I guess, is being provided. I wonder, Lisa, what I'm getting at here, I'm scrolling back through the slides. I wonder if we are in this situation here. I wonder if we've got a situation where we've got a contractual supply. The contractual flow of the supply is from your Australian company to the non-resident owner of the goods, but the service, being the sales service, for want of a better word, is actually being provided to other parties in Australia. I wonder if we fall here. Because the basic would be, if we go, the basic response would be that you've got, my basic answer is, well, it looks like you're making a supply to a non-resident who's not here when the thing supplied is done. And I'm assuming our non-resident doesn't have any presence in Australia. So if we assume that the non-resident doesn't have a permanent establishment here, doesn't have people here, all that kind of stuff, then you would say under item 2, then yes, I guess it is. But, excuse me, as I said to you earlier, if the agreement is with the non-resident, but the supply is actually being provided to another entity in Australia, that will not be GST free unless that other entity is an Australian-based business recipient, which it may very well be in your case. So I'm thinking that the goods are then sold directly to the Australian entity, not the client. But the goods is a different issue itself. The goods have to be treated or have to be looked at differently to the service. So your client is providing a service, not goods. So your client's service is the sales service that it's providing. I guess it's providing a sales service to someone else in the indirect tax zone. If that someone else, being the Australian clients, are registered for GST, then so that they would be Australian-based business recipients, then I guess that would still be GST free. But hang on a minute, let me just go back to something else. The suppliers, neither supply work physically performed on goods. No, they're not physically performing work on goods, are they, Lisa? And the non-resident's not carrying an enterprise here. No, they're just literally providing the sales service. My gut feel is that it is GST free provided the Australian entities that they're selling the goods to or selling the goods on behalf of the non-resident to, are registered for GST. That is my gut feel. The other thing I'll say to you is obviously the goods themselves have got their own GST treatment. So the goods themselves, I guess, you need to look at whether they're taxable importation and who's doing the importing. So I presume your client is not doing the importing of the goods. I presume either the non-resident supplier or the end recipient, the end Australian customer, is either doing the importing, and that will determine whether it's a taxable importation or a taxable supply. But that doesn't affect, I've just seen your comment now, that obviously doesn't affect your client, who's the go-between. So that's my answer to that one, Lisa. Hopefully that helps. Mark, I don't understand what clipping the ticket means. But it's a phrase I'm not on top of. Well, I think providing Lisa that the Australian recipient of the supply is registered for GST, because I think otherwise this section here, which I've got on the slide now, section 38.190 subsection 3, will say that it's not GST free, because although contractually you're providing a service to a non-resident, you're actually making the supply to someone here in Australia, and that is not GST free unless the entity to whom you're actually providing the supply is an Australian-based business recipient. So registered for GST and making the acquisition in respect of their enterprise. So I think that's probably my answer.
Thanks, Debbie. That was a great question. A few other things that came out of that as we went through it. Got them all together. So thanks very much, and thanks to all of you for popping your questions in the chat box. Really appreciate that. Can you just pop to the end to your last slide, if you don't mind, Deb, just so that we can have all those good tax banter stuff at the end there, which will be great. Thank you very much. So just a reminder, as you exit to,
there we go.
We'll be redirected to that short survey form. We do take the time to fill those out, and all that feedback does go back to Debbie and to Tax Banter, and so we really look at them after each and every session. Look forward to having you back on board again soon. Thanks, everyone.
Thanks, Michelle.